Hi everyone, welcome to the webinar today. We'll just kick off in a minute or so and just getting everything set up, and thanks again for joining the call. Thanks everyone for joining the call. We'll give it another minute or so and then we'll be able to kick off. Thank you. Okay, well, it's a couple of minutes past the hour, so looking forward to presenting today our Are You Ready guide for 2024. And after an eventful 2023, we expect to see further volatility and uncertainty as we go into the new year. Of course, this is our yearly flagship document that we produce looking ahead to the year ahead and helping our businesses understand the risks and opportunity and prepare for some of the big drivers that will affect the economic and FX outlook. My name is Stephen Dooley. I'm the head of market insights based out of Melbourne. We've got Boris here today as well, out of our office in Vienna. Boris, thanks a lot for joining the call today.
Thanks, Stephen. Thanks for having me.
Okay, let's look at the agenda for the session today. First of all, we're going to look at some of the insights that we've received from our customers. We did a survey a bit over 2 months ago to understand what is the biggest concern for our clients. And I think that's a good way of setting up as we look ahead to the 2024 global market outlook. Not looking at everything that this is contained in the report. Of course, this webinar is part of the Are You Ready report. That's about 30 pages long, looking at a whole range of themes, macroeconomic drivers, and currency forecasts. Of course, we can't cover all of that today. We've just got some of the edited highlights, but happy to share that with you. Boris will be looking after the global market outlook, and then I'll look at the regional outlooks and FX forecasts. And of course, what we'll be looking at today is some of the majors, the euro, the British pound, the US dollar versus the Japanese yen. And then we'll be looking at some of the regionally focused currencies, the Aussie, the Kiwi, and the dollar Sing. Then we'll look at some of the trends that we've identified from our clients and thinking about some of the ways to manage FX risk as we go into 2024. And then questions. We'll keep our Q&A at the end. But if you have any questions, please just use the Q&A tab here on your Zoom controller. They'll be able to help you on that. All right. Well, let's kick off. And as I said, what we've started off with this, year is by having a look at some of the insights that we received from our customers. A survey that we actually did on a webinar a couple of months ago. And it's interesting that, as SMEs and corporates continue to deal with cross-border frictions, it remains one of the more difficult times to manage foreign exchange. We've seen over 155 central banks raise rates 500 times between August 2021 and 2023. And that has been the big driver of FX market volatility. And what we've seen this year has really been clearly shown is that what's been the biggest driver has been those divergence between what central banks are doing. And you think about as we got to the end of 2022, the US dollar was absolutely dominant because markets believed that the US economy was running very hot and would need to keep raising rates a lot quicker than other central banks. As we got into the start of 2023, we had the European Central Bank and the Bank of England really front of mind in belief that high energy prices would cause those central banks to raise rates quicker than other central banks. And now, as we got to the end of this year, the US really does continue to be the central bank that has interest rates the highest at 5.5%, along with New Zealand and a couple of other central banks. And the US dollar really has remained dominant. So this year, it's been interest rates and central bank moves that have really driven the volatility. And you can see that in the survey that we had conducted with those clients. High interest rates and high inflation were the biggest concern. 71% of respondents surveyed said that was their biggest concern. Of course, the numbers don't add up to 100 because respondents could name more than one concern. But then after that, cash flow and credit remained really critical. And as interest rates go up, of course, that impacts on the availability of credit. And we've really seen that with a number of data sources, particularly something that Boris will look into at the moment with the SLOOS, the Senior Loan Officer Survey in the United States, seeing that credit availability is really tightening. Now, of course, this survey was done back in August, and geopolitical trade risks, Russia, China, were front of mind, but we've seen that become even more concerning over the last month and a half with those increased tensions between Hamas and Israel in the Middle East, also impacting on financial markets. So as we go into 2024, it's really going to be driven in terms of the big moves in financial markets. It's going to be driven by the next phase in the global economic cycle. We've had this period of stronger than expected growth in 2023, but as interest rates remain high, will we see a recession? And will that recession eventually cause central banks to cut rates? So that's why we put together this report, to help our clients understand these concerns, to help them manage these concerns, and to provide forward guidance on the global macro themes that could reshape FX and trade in 2024. This is what we try to do every year with the Are You Ready report. And again, we're trying to do it again to uncover the emerging trends and events that might lie ahead. So what I'm going to do now is pass on to Boris, and Boris is going to spend 15, 20 minutes looking at some of the big economic themes into 2024, and then I'll come back and look at some of the impact on FX markets. Boris.
Amazing. Well, thank you, Stephen, for the lovely introduction. And of course, for also presenting the client insights, because what I would like to do next is actually build on these topics, as you said. We know that they have been quite important, not only to our clients, but also international businesses in general. Not only from a macro perspective, as you said, but also from a risk management perspective with these geopolitical tensions starting to rise. But they've also been major volatility drivers over the past few years. And this is why, as you said, we have prepared 4 topics corresponding to 4 specific calls or forecasts we have going into 2024. We will start with our views on the global economy and monetary policy. We will look at financial market behavior, and then we will conclude with international trade and geopolitics. And the goal here is to just simply give a better understanding of why these topics are so important for us and for our clients. And second of all, to just build a better base for understanding where our FX forecasts actually come from. So with that outline in mind, we can, I think, already start with the first slide, in which we try to basically put forth our views on the global economy and, as I said, monetary policy. And it is probably the most important or even the most difficult call to make in any year ahead outlook, given just how unique this post-pandemic period really has been. So just to put a bit of context into how or where we are headed going into 2024. So the backdrop is that, as you said, central banks worldwide have increased their interest rates more than 500 times over the last 2 or 3 years. And at the same time, they've also started significantly decreasing the liquidity they are actually providing to the markets. And this drastic pivot from the easy monetary policy that we have become used to and that has governed financial markets for well over a decade to such a high rates regime has definitely left its mark on economic activity. The global economy has what we would call entered a pro-cyclical recession, meaning that while global economic growth is still well above average, all the pro-cyclical and interest rate sensitive parts of the real economy are already contracting. Think manufacturing sector, global trade, and the property market as well. Those 3 sectors have already been in a recession for quite some time in most countries that we have looked at. Mortgage rates, for example, that everyone is aware of, has risen to the highest level since the global financial crisis in Australia and also in Europe. And in the UK and the US, mortgage rates have already reached 20-year highs. And this has, of course, put pressure on the construction sector, on property prices, and on existing home sales. And if we turn to global manufacturing and world trade, they've also been in a recession since around Q2 this year. And I think this, against this kind of weakening backdrop and the pro-cyclical recession, we kind of start to go into our first calls for 2024, meaning that in our belief, we think that economic growth will continue to be weak going into the first half of 2024, just because the US economy is expected to slow. We are expecting these lagged effects of high interest rates to linger around. And this is why the next 2 or 3 quarters will probably be weaker than we would expect, especially given that the consumer so far has really held up against these higher interest rates. And we are currently seeing leading indicators suggesting that the consumer, the global consumer, is weakening and that labor markets are starting to ease. And this view culminates into our forecast that is represented in the first line here, which is that we are expecting sub 2% real GDP growth for 2024, which is something that we didn't really see outside these crisis years in the 21st century, meaning 2009 and 2020. However, just to put a bright note on it as much as I can, we are expecting inflation to come down quicker in most countries that markets are currently pricing in. And this kind of supports our view for a call for the Bank of England, for the Federal Reserve, and for the European Central Bank to cut interest rates next year. And given this monetary easing of these G3 central banks, of course, under the assumption that inflation doesn't surprise to the upside like it did this and last year, the second half of 2024 could see a revamp of these pro-cyclical sectors that have been hit so hard over the past 2 years. We also need to keep in mind that, yes, this is a global outlook. It is important to know what is happening on a global basis, but it's not nuanced enough to just on its own make an immediate FX call, as we will see later on in our FX section. Because within this global trend of economic weakness, we have regional differences. And this is why, for example, we expect a slight European recovery in 2024. We are expecting the US to weaken and maybe fall into recession in the first half of next year. And this is why we're expecting the RBA, for example, in Australia, to only cut rates eventually in Q4 next year, much later than all the G3 central banks. So in our opinion, these divergences will be more that is driving volatility and not kind of the global trend or global picture. So with this in mind, we can already look at the implications of this view on financial markets on the next slide. So once again, just to put kind of the past few volatile months into perspective. So the global stock market as a whole has been in a sideways trend since the beginning of last year, really. And this doesn't mean that volatility has not been high. I mean, on the contrary, we have definitely seen high volatility in stock and in bond markets. But in general, one could definitely draw a flat multi-month trend line over most stock benchmarks, and especially the global stock benchmark. However, we did go through a couple of phases over the last 2 years, and they are, I think, important to highlight. So between January and October 2022, the leading stock indices in most countries fell, right? Primarily due to, again, the war in Ukraine. We had the energy crisis, we had rising interest rates, and still high inflation. And the recovery rally that began in October last year started because we have pretty much reached a triple peak of interest rates, inflation, energy prices, but also the US dollar. And stocks started rallying in October based on this sense of an improved global economy and kind of the effects of the war starting to fall off. And this recovery from October continued until mid-July 2023 this year. And since then, shares have fallen back across the board. So we can see that we have seen quite volatile trading in stocks. They are or have been moving in phases. But the important thing to note for us here is that these 3 phases that I've highlighted for stocks over the past 2 years, bonds didn't really go through these phases. The price of government bonds has consistently fallen over the last 2.5 years since the start of the global central bank tightening cycle, because as the price of bonds naturally have an inverse relationship with the yield, it means that if central banks increase their interest rates, yield rise, and then the price of an existing bond falls. And these interest rates, as Stephen mentioned in the beginning, have been so extreme over the past 2 years that US bonds, for example, lost 50% of their value, which was the largest yearly loss since at least the 1970s. And there have only been 4 years in modern economic history where stocks and bonds have fallen so sharply at the same time. And one of them was 2022. And bonds, of course, continued their descent in 2023. And because of this extreme movement of bonds in recent times, and just the fact that we believe that the Federal Reserve will most likely stop raising interest rates, we see bonds as a good investment for the first time in probably 3 years. And in this chart right here, we try to show how different asset classes have historically performed or behaved once the Fed had ended its tightening cycle. And what you can clearly see is that the median performance of our G7 bond index, for example, 250 days out after the Fed stopped tightening, is incredible 16.6%. And this means that we expect with, again, yields falling, central banks being done tightening, it would make sense for bonds to outperform and also for stocks to outperform. Because in this scenario, again, Fed stops tightening, the US dollar tends to fall, stocks and bonds tend to rise. Of course, it's not that important of a simple forecast going into 2024, because if we start differentiating this analysis and look a bit more deeper, not only how stocks behave after the Fed stops tightening, but also consider if the Fed stops tightening because the US is falling into a recession or not, we can clearly see that historically, if the Fed stops tightening, but the US falls into a recession, this means that stocks in the short term perform quite negative. And this kind of dampens our outlook for 2024. Yes, we are expecting bonds to move up. We are expecting stocks in general to be positive. But given that we are also forecasting quite weak global growth and US economic growth, this kind of dampens our risk on forecast for the first half of 2024. And this is why a substantial risk rally is kind of, in our opinion, reserved more to the second half of 2024. It is also important to note that all these assumptions and forecasts that we are making right now are, as Stephen mentioned in the beginning, really limited by these geopolitical and trade political uncertainties. And this is something we can see on the next slide, I think, because especially now when investors, companies, consumers, when they're all faced with potentially three geopolitical fronts, not only in Europe with the Ukraine war, the Middle East, and also Asia and kind of the tensions surrounding Taiwan. And this is not always about military conflict, of course. China and the West have seen strong diplomatic, but also trade-related tensions rise since at least the year 2016. And we know that Australian, Japanese, Korean, but also European companies have really been caught in the middle of these disputes recently. And this is something that this slide, for example, is really US-centric, showing the relationship between the US and its two largest trading partners. But normally what I would like to do is give it a bit of a spin that highlights the worries of our European and Asian, specifically Australian clients. So in this context, I would always like to quote two interesting surveys that have been done by two consultants, PwC and KPMG, because they really highlight the Chinese dilemma that international currencies and international companies are currently facing. So the first one is that 88% of German companies are still seeing China as the most important trading partner in the future. But 77% of them also already consider alternative or additional locations to be really essential to their existence. And more than 1/3 of these surveyed companies have already failure strategies in place in the event of major crises and war. And the same goes true for companies in other countries. Australian companies operating in China, for example, said in a recent survey done in November that the complexity of regulations and just the difficulty in finding relevant information are the biggest obstacles for setting up business and partnerships in China. And more than 40%, which is very interesting because it ties in with our own internal surveys, more than 40% of companies said that the changes in the international situation and these geopolitical tensions and higher operating costs could threaten the business in China. And we can kind of see here why this black and white thinking when it comes to China is really out of place. Because it is true on one side, through various structural changes, that the Chinese economy is definitely entering an economic regime in which growth rates of 6, 7, 8% per year are definitely not feasible anymore. But the country is still one of the most important trading partners for most of the Western world. And it is really difficult in the short term to try to replace China as a whole. On the other side, it is also true and has to be noted that this promotion of its own economy and domestic companies through these subsidies from Beijing and just the geopolitical unpredictability are simply factors that a company has to take into account when making decisions going into the next couple of years. And this definitely won't change going into 2024. Just to give kind of a other perspective on this, the two big headlines regarding trade this and last year have all revolved around China. So the first one that was quite prominent in Europe was that for the first time, China overtook Germany in 2022 and then Japan 2023 as the world's largest automotive exporter. And the second one was something we see in this chart, which is that Mexico overtook China as the biggest trading partner of the US. And both, in my opinion, basically highlight the same exact trend or principle, namely that China is, first of all, moving up their exporting value chain and becoming more of a domestic consumer-facing nation. And therefore, spending some time looking into how to possibly de-risk your supply chain ahead of any escalation could definitely be pivotal for some companies in the future. Obviously, diversifying from China or near-shoring, as some would call it, is definitely something not every country or even every organization will find easy to accomplish, especially given different dependencies and even different policies in different regions. But just being aware of the changing trade relationship and Chinese policy will definitely become important going forward. Just in terms of, to finish this off, just in terms of our forecast for global trade, we do expect next year to be a bit better than 2023, because as I said, global trade is officially in a recession since April this year. However, as we said, interest rates are expected to fall slowly, and China is expected to kind of start at least recovering in the first half of 2024. And this is why, even though the growth rate of global trade will be weak in 2024 compared to its pre-pandemic trend, we are expecting growth rates to be positive in 2024, with the major recovery coming in 2025, when most of the central bank policy easing will start impacting the real economy. In addition to these issues with China that I think are front and center, on the next slide, we just touch upon a couple of different geopolitical factors that are currently in place. And one of them is, of course, something that Stephen mentioned, which is the Middle East conflict that is currently being monitored quite closely by investors and companies. In terms of financial markets, the conflict between Hamas and Israel hasn't really, or has had quite a limited effect on markets apart from just a short-lived shock. And this is because markets generally tend to discard these geopolitical tensions because they don't think that they will turn into massive conflicts. And this narrative can definitely change over time and can impact markets. But so far, if we look, for example, at our basic forecasts, we mostly assume that there will be no major conflict or an escalation of the broader war. However, we also model an escalation and rise in oil prices above $100 per barrel as kind of a downside scenario in our currency forecast. But again, that remains something to be discussed in the FX forecasts and remains kind of a marginal scenario for us. A second topic that has also come up in this section are the upcoming elections that definitely have the potential to shape financial markets in 2024. Historically, as I said, like with wars, elections in developed markets at least have really been mostly overlooked by investors and companies due to just other important factors being more of a price driving factor than elections itself. But again, we said that in this case, these individual elections on their own probably don't have enough of a power to shape markets, but them taken in general as a whole, it is definitely possible that some new narratives are starting to emerge, like, for example, the China story, the geopolitical tensions rising story. One, just to be in particular, looking at the elections for next year, I mean, one is, for example, the European parliamentary election and the regional elections in Germany. And this really highlights the case we want to bring home here, because both individually don't really have the power to shape markets that much next year. But combined together, we get a narrative that has been driving European politics for at least a couple of years now, which is the populist rise in Europe. We've seen in the last couple of months regional elections in Germany, where the victories of the right-wing AfD party have really started being noticed by investors. And the European parliamentary election as well will probably become a ground for discussions about the future of Europe. First of all, Europe's industry, and then most importantly, its relationship with the US and China. There is, of course, one election that has the potential to shape markets, and this one is, of course, the presidential election in the US, because Donald Trump is still by far the most popular candidate if we look at the current forecasts and the polling. And the outcome of this election will not only be important for the US, for US companies, but also for companies in other countries, because the US's election, or the US's relationship in this case, with Europe, with China, with international companies, is definitely important to keep in mind. And another win of Donald Trump in his second election would definitely be something that increases volatility going into the end of 2024. As we can see here in our graph, looking at the Euro-USD chart across the period where we had the US election, you can clearly see that it really took a long time for the Euro sell-off that was triggered by Trump's victory in November 2016 to be normalized again. So the Euro really suffered for quite some time until it started regaining some strength. Yeah, just to kind of quickly summarize my points and cases before handing over to Stephen and the FX outlook. So looking broadly, kind of our assumptions and views for 2024 are that we have said that the global business cycle is currently in a downtrend. It is in a pro-cyclical recession, and it is mainly driven by these risk-sensitive and rate-sensitive industries: manufacturing, the global property market, and global trade. On the bright side, we are expecting inflation to ease in most countries, even though, as I said, it is a bit nuanced looking at individual regions, as will Stephen do. But in general, we are expecting inflation to fall, and we are expecting the G3 central banks to cut interest rates next year. Firstly, initiated by the ECB in the first half of next year, and then going with the Fed and the Bank of England at the second half of next year. And this easing and the kind of the recession call for the US next year should support our bullish view on bonds and bullish view on stocks going into the second half of next year. China, as I said, in general, and the elections in the US and Europe will also matter for investors and companies, not individually, but again, as they are shaping to become broader narratives and broader themes that companies and investors are looking at, this is when these events become market moving. So I think that is all from my side, and I would like to hand over back to Stephen for our FX views going into 2024.
Thank you very much, Boris. That was absolutely awesome. Really appreciate your views and you presenting for the team here in APAC and the west coast of North America outside of normal business hours. Great stuff that Boris delivered here. And as we mentioned, this material is all explored in more detail in the Are You Ready guide. We talk about a number of other big drivers of the sort of macroeconomic landscape as well, particularly looking at, as we mentioned, the impact of interest rates, the impact of what we've seen in some of this tightening in credit conditions and turning of the business cycle. And of course, as Boris finished up with talking about the risks for geopolitics as we go into the new year and head towards that US presidential election. So that's all there available in the Are You Ready guide that you can download. Of course, for our business and for our customers' business, the biggest impact is what happens in foreign exchange markets. So we'll have a look at some of our forecasts with that great background that Boris was able to give us. And like I said, what we're going to do is to look at some of the FX majors, and then we're going to look at the regional market in more general. The euro US dollar, it's the biggest and most important currency pair in the world. And as I mentioned in the introduction, really quite a significant move that we've seen over the last 12 to 18 months, falling below parity in the middle of last year. It feels like a long time ago. Falling below parity with worries about the impact of the Russian invasion of Ukraine. But big snap back in the euro. We've seen that in our region. The euro has been remarkably strong versus the Aussie, versus the Kiwi. And that was really driven by a belief that, again, as a result of those geopolitical tensions, as a result of high energy prices because of a lack of supply from Russia, those high energy prices were creating a very overheated inflationary outlook and causing the ECB to raise rates above 4%. Of course, rates were negative back here at the start of 2022 in Europe. So it was a big move higher. But over the last couple of months, we've come to the realization, and markets come to the realization that the European Central Bank probably can't raise rates much further. The European economy just doesn't have the resilience to be able to cope with those higher interest rates. And so as a result, those expectations that the European Central Bank might need to raise rates above 5% or even higher, they've well and truly been eliminated now. And markets believe the ECB is done. And they also believe that the European economy is going to struggle to recover. So as a result, the outlook for the euro over the next 12 months is starting to look a little bit more negative after a real time in the sun, that sort of 12-month period where the euro US dollar bounced from 95 up to around 113. Not a lot of hope for euro strength. That will probably come to a bit of relief for a lot of the euro buyers throughout APAC. But the outlook for the euro, not particularly positive as we go into 2024. And of course, at the moment, around 107 over the time horizon that you can see here, only up to around 109, 110. So a little over 2% or 3% recovery in the euro, according to those forecasts. Again, when we're thinking about what that means in APAC, it depends on whether we see a rebound in the Australian dollar, whether we see an improvement in the Singapore dollar. If so, then those currencies can make gains versus the euro. So it appears that we've had a period of strength for the euro over the last 12 to 18 months, an incredible move from 95 up to 113, but that does seem to be now behind us and going to 2024, much more muted expectation for the euro. The British pound actually trod a similar path. And again, it was all because of the same story. And again, driven by those geopolitical issues, the rising energy prices also in Europe also impact on the UK. And as a result, we've seen the Bank of England raise interest rates above 5% in the United Kingdom. And that's what drove another big move, 30% higher in the British pound between that record low in the middle of last year, of course, after Liz Truss's infamous mini budget, and since then up to around 131. It's come off a lot since then, down to around 122. We do expect to see a bit more of recovery in the British pound, up to around 128, 128 at the end of next year. But again, unlikely to see too many more rate hikes. Well, in fact, unlikely to see any more from the UK. They have settled at a higher level, as we say, above 5%. And as a result, that can provide a bit of support to the British pound. But again, some support, but don't expect to see the kind of strong gains we saw in 2023. As we mentioned, the British pound, the UK economy likely to outperform the Eurozone, but only moderately. They do have some issues to work through. On the plus side, unemployment remains relatively tight. Post-Brexit, there isn't the free-flowing amount of labour into the UK that there once was. That's keeping unemployment low, it's keeping wages growth high, and that can provide a bit of support for the British pound, particularly versus the euro. The dollar yen is going to be, and the Japanese yen more generally, is going to be one of the real pivot points in 2024 because the Bank of Japan is inching towards tightening policy. Every other central bank in the world, well, virtually every other central bank in the world has started to raise interest rates over the last 18 months. There are two holdouts, the People's Bank of China and the Bank of Japan. People's Bank of China cutting rates, the Bank of Japan keeping rates extremely low, hasn't started to raise rates. But inflation is pushing up in Japan, and in FX markets, it's not necessarily the nominal or the real level of interest rates. It tends to be the change in relative interest rates that has a big impact. And if the Bank of Japan continues to slowly tighten policy at a period where the Federal Reserve, as Boris said, has got the risk of cutting, then that's when you can see the dollar yen start to fall, and you can start to see a period of strength in the Japanese yen. So don't know when it will happen. The Bank of Japan can be glacial in the time it takes to change policy, but if and when they do, it can be a very substantial move lower in the dollar yen, a substantial move stronger in the Japanese yen in particular, and that's certainly what we're looking for. And you can see that the spread of scenarios is very significant as we go out. The base case at 135, but almost a 25% spread in our scenario, our central scenario. But what's interesting is that none of it's really above 150. And the Bank of Japan have said time and time again that 150 is the line in the sand, 150 to 155 now. So broadly, the view is that when it comes to the Japanese yen, the key view is for a move higher. When and how much will be driven by the Bank of Japan. Another market that's been rattling up near highs is the dollar CAD, and the dollar CAD up around that 135 level historically, around a sort of a 2-year, even 3-year high now, has been driven by, first of all, the stronger US dollar, but second of all, a story that we're very much aware in Australia, in APAC, but a slowdown in global growth means that commodity prices can weaken. And that's been particularly the case most recently over the last couple of weeks with the crude oil market. Crude oil down at 3-month lows, fallen quite significantly, causing the Canadian dollar to fall and the dollar CAD to move back up towards those highs. Again, interest rates in the US and Canada are pretty much at the same at 5.5%. So the interest rate differential isn't quite as significant in driving this market. It's more about an economic outperformance, and particularly crude oil market. But again, as we say, this is historical, a very high level for the dollar CAD. And the view is that as the Federal Reserve starts to ease into the end of into next year, that the dollar CAD can start to fall. So a bit of Canadian dollar strength, but as I said, it's really a dollar CAD story. The Canadian dollar otherwise relatively weak versus a number of other currencies, due to that depressed outlook for commodities in general and crude oil in particular. The Aussie US moving away from some of those majors and into the currencies that we look at here locally. The Australian dollar historically has not spent very much time under 65 cents. Over the last 20 years, it's been under 65 for about 3% of time over the last 20 years. So it's a historical abnormality to see the Aussie dollar so low. And as a result, this period of strong US dollar strength, if that starts to ease, and the Aussie dollar can snap back quite quickly. The other story, of course, is on the Chinese economy, and we heard just this week that the People's Bank of China has now accepted that growth in China has settled at around about 5%. Those double-digit days of Chinese economic growth over the last 20 years are behind us. The Chinese growth story is still strong, but it's not in that period of extreme outperformance that we saw as the country was really developing and industrializing. Now it's a much more mature economy, very hard to get 8 to 10% growth in a mature economy. So this slower outlook for Chinese growth means that the Aussie dollar might be capped, still around high 60s to 70s, and you can see our core view as we go out to the end of the year between 65 and 73. But it will take an improvement in Chinese economic growth before we can really start to move above 70 and beyond. So while we do expect to see a rally in the Aussie dollar in 2024, we don't expect to see a move significantly above 70 without strong Chinese growth. And as a result, US dollar buyers might start to accept levels between 65 and 70 as being good levels. And in the short to medium term, those 70 levels that we've seen, on and off for the last 20 years might take a while before we get back to those levels. So US dollar buyers in Australia looking to lower their expectations. Probably the same in the Kiwi US as well. The Kiwi had quite a significant move from up near 65 here at the start of the year to around 58. It's at 59 now. And a similar story to what we saw in the euro, where at the start of the year, the view was that New Zealand interest rates would be higher than the US. They raised rates in New Zealand up to 5.5%. Was seen as unlikely to see the US at those levels. They have raised rates. They're close to 5.5%, exactly at 5.38 at the moment in the US. And as the US started raising rates quicker, really eroded the attractiveness of the New Zealand dollar, which has been for a long time a home to speculative money, looking to take advantage of the interest rate advantage. As New Zealand became relatively less attractive compared to the US, that's when we saw that fall from 65 down to 58. And again, with US interest rates likely to remain high, at least in the medium term, hard to see the Kiwi moving back above that 65 level. And you can see here for the balance of 2024, that view is between sort of 59 to 65. Of course, what we try to do here when we're talking about the range of forecasts, what we're trying to do here with the range of forecasts is to provide an idea about that volatility that we tend to see in markets. It's all very well and good saying where we expect the market to be at the end of the year, but that doesn't tell the whole story about the kind of volatility. And when it comes to the New Zealand dollar, of course, one of the most volatile currency pairs historically since the New Zealand dollar floated in 1985, traded on average 20% per year. The Australian dollar on average about 19% per year. So again, if you look at sort of 59 to 65 and say that seems like a lot, it's actually well below the long-term average, and the long-term average actually equates on the Kiwi to being between about 12 and 14 cents, and that's this range from 56 to 69. So you can really see here that this is the kind of path you can expect to see over a 12-month period, as we mentioned in the Kiwi and also in the Australian dollar as well. Now, the dollar Sing tends to be a currency that sees somewhat less volatility, broadly around about 8.4%. Well, it's just written here, isn't it? Around 8.4% since 1986. And again, that's why you can see here in terms of the range that we have here, it's a bit smaller in the dollar Sing compared to the other markets. But regardless, still can have a significant impact on a business. Again, as the global economy likely to struggle for the first 6 months, but more of a recovery towards the end of the year, that can be positive for the Singapore dollar. The Singapore dollar, of course, closely tied to global trade volumes as one of the world's key ports. It's actually quite closely tied to global trade volumes and crude oil. Just under 10% of the GDP of Singapore is tied to crude oil refining. So both of those factors. So it tends to be quite economically sensitive. So, a bit of a pickup in growth needed for the dollar Sing to sort of move from these lower levels, or to move from those higher levels into those lower zone. But again, you can see the range that we expect to see. A bit more volatility at the start of the year, and volatility maybe quietening down towards the end of the year as some of those interest rate changes are worked through. Finally, on the dollar CNY, and again, another market where you can see looks to have sort of topped out recently. And of course, the People's Bank of China has been actively pushing back against the dollar CNY as it moves above 730. A range of different strategies pursued by the Chinese central bank, encouraging state-owned banks to sell US dollars, historically moving the daily fix, the official rate, well below the market rate. A number of different techniques that clearly tells us the People's Bank of China want the dollar CNY lower. And that's, again, why we think overall the view as we go into 2024 is for the dollar CNY to head back lower down towards that 677 level at the end of 2024. Again, China has been one of the key stories. And again, we discussed this in more detail in the Are You Ready report. But, the start of the year, China, real hope for a boom in growth, didn't really eventuate, and for a couple of reasons. A couple of reasons. First of all, Chinese consumer has been a bit reluctant just to go in and splurge after 3 years of COVID. The Western world tended to spend big. In China, probably a little bit more cautious, but also a slowdown in global manufacturing activity really weighing on Chinese economic growth as well. A bit of a pickup in Chinese growth might help the dollar CNY move back lower. Well, that's the currency forecasts part. I just want to touch on some, before we finish, on some risk management trends that we've discussed in the report. Again, a lot more detail in the report, but just to quickly touch on it, what we've seen is interesting is a real increase in some of the demand for hedging in some parts of the business. And if you look here at the the average total forward contract per turnover per customer, it's risen quite significantly by around 55% between 2019 and 2022. And one argument that can be made is that firms have implemented business strategies aimed at countering or smoothing out the variable costs of doing business when sending or receiving currency payments globally. It aligns with that big increase we said at the start of the year in interest rate hikes. Interest rate moves from central banks drive volatility, and volatility tends to cause businesses to be more aware of the risk in FX, their FX exposure. Now, he mentioned the last 2 years have really been driven by interest rate increases and that impact on foreign exchange markets. as we go into the next 12 months, and it might be interest rate cuts that can see certain currencies fall quicker than other currencies. So again, we were talking about the cycle, about the global economic cycle, and it appears to be that we're near the end of the rate hiking cycle. This is what Boris was talking about in terms of seeing the US dollar tends to fall, bond prices tend to go up by around about 5%. The G7 equity market weighted average tends to go up more than 15%. So as central banks start to cut rates, that can drive volatility as well. So that's really what we'll be watching, and it might result that businesses see more and more the importance of managing, countering, trying to smooth out the variable costs of doing business by using some of these hedging techniques. And that's all part of what we do at Convera, of course. And this is the purpose of the report, to help businesses when they think about what will currency volatility do to their business? How can they manage that with risk management? What will geopolitics do? How can you manage that? Not just the big moves that we see as a result of the US presidential elections or geopolitical tensions, but diversification into different regions, like we've seen Mexico suddenly outperform China into the US. How can we help businesses with a diversification? Sanctions, which were an incredible issue that we helped our customers with in 2022 after that Russian invasion of Ukraine, and of course, helping businesses to manage their carbon footprint with some of our ability to help businesses manage their carbon offset credits and certification. So you have questions about how we can help with currency volatility, geopolitics, sanctions, or climate, then speak to your Convera representative. Okay, well, with about 5 minutes to go, it might be good to see if we have any questions. And we have got a couple. And Boris, I think the first one might be for you here, but we did touch on it, but we didn't touch on it very much. And that's our apologies. It's hard to cover everything in 55 minutes. But one question wanted to know the outlook for China as we go into 2024. We did talk about some of the issues in China in 2023, but Boris, as the sort of the global macro specialist here, what's the outlook for China? I think you're still on mute there, Boris.
Apologies. Yes, as I said, I mean, really interesting question, because China is a key story of, or has been for 2023, will continue to be for 2024. As you mentioned, the Chinese reopening from its 2-year lockdown policy has definitely disappointed so far. Economic growth will be around 5%, will probably be sub 5% next year, which first of all sounds good compared to kind of the sluggish growth in the rest of the world. But again, compared to Chinese pre-pandemic levels, it's not really something that the Chinese Communist Party really likes to see. And we are expecting, as I said, a recovery of these pro-cyclical, really stressed markets, the global manufacturing market, property markets, but this will probably not be enough to, again, secure China this above 5-6% growth over the long haul. And the latest data, even today, for example, before the webinar started, Chinese inflation once again back below 0%. We had the Purchasing Manager Index for the manufacturing sector come out last week, again, showing the manufacturing sector contracting on a monthly basis. So all these new data patches are showing us that it is really hard for China to, come out of this pandemic period. It is definitely been scarred, and we have seen some easing of monetary policy from the PBOC, from the Chinese central bank, and this, which is important for us on our FX view, this pushed the rate differential between Europe and China and between the US and China to be positive for the first time since the global financial crisis, which is really important, because normally China is received or perceived as being a high yielding currency, as the Chinese one. But today, the euro and the US dollar yield more than the Chinese yuan, which is really interesting from a historic perspective. So as I said, investors are not really convinced that this is a growth story going into 2024. The Shanghai Composite is down around 10% since May. The famous NASDAQ Dragon Index for China, which basically compounds all the Chinese mainland tech stocks, is down around 70% from its peak reached in 2021. So as I said, investors are not convinced, but on the flip side, it is something that, given that sentiment is so weak, there's definitely potential for upside surprises in 2024. And again, a strong China would definitely play into the cards of the euro and the Aussie. So it is something that we are really closely watching on a month-to-month basis here.
Great. Thank you, Boris. We've got a couple of other questions, but we're running out of time here, so we'll get back directly and cover those questions. But I'd like to thank everyone for coming along today. Really appreciate the turnout. I want to really thank Boris for some great insights. Boris was really driving force in the Are You Ready guide this year. So thanks again for your work on that and your work today. If you have any other questions, please make sure you speak to your Convera representative. Here's the disclaimer. And thanks again for coming today, and all the best. I hope you're ready for 2024. Thank you. Bye-bye.